Hello everyone, welcome to Fearfully Greedy. In today's episode, I will share with you my checklist tool. It's something I use before doing any investments. It keeps me in check, there's the name, and I think it's very useful for an investor. Also, if you are new to the channel, here I share a public portfolio with you, also investing tools, ideas, sector analysis, company analysis, and all those sort of things. So if you are interested, consider leaving a like and subscribing. As you can see, I'm sitting at 18,000 euros, close to a 2,000 euro gain, 12%. If you compare it to the previous video, the market has been falling a bit, so it's a bit lower than the previous video. The project started on the 13th of July, and so far I have put 16,000 euros in, but no changes. So since the last video, I haven't done any trades. This is value investing. I don't buy and sell too much. Most of the times I just buy, I keep adding to positions, and maybe in some time when these positions get close to intrinsic value, I might sell and buy something else. As always, as every video, these and all my videos are not to be considered financial advice. Please consult a professional or do your own research before investing. Today's tool I will share with you is also just for informational purpose only and should not be considered as a buy and sell tool for your investments. I also thought that although this is my checklist, and on last video I shared my intrinsic value calculator, if you want to say it like this, my investing process it has more parts, right? I wanted to share you so you can position my investing process. First step would be I start screening, or I get an idea from Value Investors Club or Reddit or Twitter. An idea can come from many places. Then I do a rough valuation just to see if it's any interest at all, because we have a finite amount of time. Then I do a company analysis, something a bit more in depth, a sector analysis. I want to compare it to its peers. Once I have a clear idea of the company and the future cash flows, I do a DCF valuation, a bit more thorough, have a more exact idea of the price I'm willing to pay. Then I do an investing thesis. This should be a document or just an explanation or something you have in your mind where you could explain to another investor why you are investing. Then what it comes is the checklist. Is what I will share with you today. This is the final step before investing, and it keeps me from doing mistakes. We're all humans with monkey minds. So it's important to have a checklist to keep you in check, right? They're the name. And it helps me a lot. I think it's a great tool for almost an investor, right? So I will show you my checklist process. First, there are two documents. I do a written one where there are many questions that I have to answer about the business. It's 19 questions with some sub-questions. Once I have written all of them, I do like a evaluation of the questions. That's because if you do it all in one step, what happens is you have like some anchoring effect. Like if on the first questions this company ranks very high, it might be entirely possible that we give a higher grade on the next question, right? So I find it's very good to just bring all the questions, and at the end I rank them individually, right? So first the document, then the marking, right? Now I will go over each question on the document, right, to see what kind of answers I'm looking for, and at the end I will show you how we rank them. First question is if I understand the business and how it makes the money. Let's say this could be as short or as long as you need to explain the business, but you should know why it's a good business, why it's not, and how they make the money, right? If it's, let's say it's a baseball card business, it should tell you how they acquire the cards, how they acquire clients, why is it better than their competitors, and all of that. Something that helps me in that is getting the best feature and the best detractor of the company, and then also what are the main competitors, and just seeing what are the market players. Like, I'm not trying to see the exact comparison between every line, but seeing more or less who are they competing with and why and how they are doing, right? The next question is about the moat. If I see a moat is something that protects our business. Say, analyzing a business that is minor, we could say that having the rights to mine that one mine is their moat, right? Someone else they cannot go on that mine and mine it, right? But the moat can be stronger or less strong. If there are many of those mines, that moat is not so. It's not so powerful, right? Or like, let's say Amazon, they have a scale mode, right? And they have a trust mode for many years of giving you low prices, or they have a distribution mode. Amazon has many modes, so you should be able to identify all the modes and write them down here, and then also see if someone wanted to replicate that mode, how easy it would be, right? So you should answer this question. As you see, there's one main question and there are two like sub questions. Like the sub questions help you answer the big question, and this sub question is also if you can already find it in another business, like for the miners, if another miner has a mine similar or even better, you can see that they also have a mode. So you should be able to see it under competitors also. Then the third question is seeing what could go wrong. What could really destroy this business completely, right? So what are the main threats to our castle? What could really put in jeopardy that business? You should be able to see the other way, because it's very easy to see how everything could go right, but you should be able to also see how it could go wrong. So invert, right? Always invert. Also, what would it take for them to happen? Like, are they likely or not likely? And this would be the kind of answer, right? If it's like, I don't know, if the main threat you see in a business is that a meteorite comes from the sky, at that point, not your biggest problem at that point, right? So that's very, very unlikely, I'd say, right? So you should be able to rank them as very likely, unlikely, very possible in the next 5 years or something like that. Then the fourth one is if it has a potential for long-term success. Like, let's say you have a company that's an FPSO, they get oil from the sea, from the underground. Do you see oil being very dominant in the next 30 years? Yes, no. In the next 10 years? Yes, no. How good do you think the business will be in that developing time? Or if, for example, it's a radio station and they are not buying podcasts and they are not getting online, do you see them being there in 30 years? Something like that. You should be answering those kind of questions to see what the long term looks like. Then the fifth one is the management has plans for the future, because if the business doesn't have a future for 10 years, but they have plans to switch to something else or adapt their products, that can be a good substitution, right? So then you should check the track record. So if they have had plans in the past, if they are coming as they should, right? And if these plans are succeeding, because it's not just implementing them, if they are getting revenues, if they are getting profits and so on. And also if they are innovative, if they are just following what everyone is doing, that can work for a lot of years. It shouldn't be a bad part, but if they are innovative too and they are successful, that's very, very strong. Then the sixth question is if it's comparing to its peers, is it like superior to them? Sometimes when we do value investing, we see that our companies might not be the best on the segment, but they are very undervalued for being the third best, right? So also sometimes we find that the business is just not understood and they really are superior to everyone else, and the market is not seeing that. So you should find the key performance indicators of the business and compare it to their competitors. Also the margins, what are the margins in the competitors and so on. If you make much more money than your competitors, they might be able to harm those margins. Or if you make more money, you could be able to deploy it and protect your business more. So seeing how they are doing and also how that could change in the future and how. The seventh question is once you have done in the previous step, you would have a DCF valuation of the model. You want to have done that. Then also that the price for me is at least 50% lower than that. So if I think it's worth 100, it should be trading at 50 at least, or at most, right? And then also I think it's useful to do a multiples comparison, right? If you see their competitors trading at 25p, 15p, and I don't know, 30p, and our business is at 5, and we think it will survive, that should give you a good idea that in the future better things are coming. Then about the margins, we want a business compared to its competitors for its segment that it has some of the highest margins, because that will give them tools to protect their business. Also, if their margins are not super high, is it because they are investing in the business? So they are investing a lot of money back in the business, so the margins look worse? Or is if they have those margins, are they still investing to keep those margins where they are, right? The ninth question is about the financial health of the company. So you should go over the balance sheet, see if we see something that is not there. We should try to find items outside of the balance sheet even. Also, if it will need external capital. Sometimes in these times, it's not, a lot of the growth companies need this external capital. They are not profitable. So if you are in that realm, you should just know if they need capital. Like if someone would pull the plug, will we be okay, right? And then if they are very leveraged, I think a lot of the mistakes in investing come with leverage. So you should check some of the leverage ratios or just the leverage of the business and compare it also to their peers. Like if it's a construction company, they tend to be very leveraged. So don't compare like something that doesn't need any capital to something that needs a lot, because you should do compare the ratios to their segment and to your liking. Like if you're okay with a lot of debt, that's different to everyone. Then the 10th question, does the management take care of keeping the cost low and being efficient? So you want to see a management that even if they make a lot of money, it's trying to deploy that capital efficiently. So you should check the capital expenditures for the last 5 years and the maintenance capital expenditures. So what it would need to just keep going. You don't want to see it like doubling every year or going a lot over the revenue growth, because then we're not being very efficient. You want for them to think like an owner, like if it was their money, would they be spending it like they are, right? Also, this is a good place to check for extraordinary items. So if we see something that is, they say, well, we had a big problem on this factory, we had to rebuild it entirely, but this is something we shouldn't be doing every year, right? This is something that might happen once in the lifetime of the business. But if this once in a lifetime comes every 2 years, then you should be worried. You should count this as capital expenditures and see if it's raising a lot. Then the 11th question is if they have good relationship with their employees. So if people are happy working there, if they had strikes or problems or scandals with employees or unions, you do a Google search. If they had any problems with their employees, right? Also, it's a good place to ask the question if it's a place that is too reliable on one man, right? So for example, with Tesla, let's say Elon Musk, they are very reliable on that person, I think, but also for a good reason. He gives a lot to the company. It shouldn't be bad if they are too reliable, especially if the person is young, but it's a risk. Like if they rely too much on the one man, it's a risk. We have to keep that in mind. Then the 12th question is if they are of unquestionable integrity. You don't want someone that is not a good person running the business, really. That would do something bad that could harm our reputation, because that's something we can lose in seconds. Like one bad decision and you're gone, and it takes a lifetime to build, right? So we want to check the scandals, but this time for the entire firm and also for the executives of the company. We want to check their last jobs, if they did something bad there, if something bad happened in our company, if a person was responsible, if we fired that person, how we left the company. All those questions it's good to ask and see a bit the history of everyone involved. Also, in any company, there are times that something bad comes up, like some bad quarter, or a product doesn't work or something like that. Do they tell it? Like, are they okay saying bad news? Like, we had this problem, but we'll fix it this way. Or they are just like, well, we had this problem, but it was someone else's fault. Like, we couldn't see it. That's a red flag in my way. So they should tell you when bad things happen, and they should own it, right? Management aligned with shareholders. You want to see if they own stock, if it's significant to their net worth, because then we'll see that they might treat the business a bit more like owners instead of just working there. And also you want to check for the incentives plan in their contracts, see if they are getting stock, if the stock is based on more profit in the future or future revenues, see if they are aligned with our interests, right? Or if we're getting screwed, like if their incentives is like we're giving 10% of shares in options every year, we're getting so diluted every year that we're getting screwed at that point. So that's important to check it here also. Then the 14th question, do they prioritize long-term growth over short-term profit? That's also very important, because if you act like an owner, what you want, you will be okay losing a year of high profits if we invest that capital appropriately, and that protects our business in the future or gives us more profits in the future. We shouldn't worry too much of the estimates of the analysts, because that will really harm our future returns. So we want someone that is just doing the best for the business and is just not trying to meet estimates, right? So very important way of checking that, if, for example, if a company sold the side of the business in a bad year because they just wanted to meet the profits, or if they sacrifice a profit project because it would take a lot of capital, although it's very clear that it was the future, and they sacrificed it because they didn't want to harm the profits for the future years, the next 5 years, for example. Something like that you can check, right? Seeing the development of the company. So we want them to ignore short-term results and think like an owner. Then the 15th question, is management allocating capital in the most efficient way possible? What it means, if, for example, if they are deploying capital in projects that give us 5% on capital, they should be paying a dividend at that point, right? We don't want them to be putting capital in businesses that don't make sense, right? So that's analyzing all that, because if they can reinvest that money in their business, high amounts of money, that's a very good business, right? But if they cannot, they should be paying almost exclusively dividend and just keeping enough to protect the business. Also, a good thing to check here is if they made acquisitions on the last years, if they paid too high valuations, if they bought something that made no sense, if they had to resell that side of the business in the future in a loss. And that is important to keep in mind here. Then the 16th thing, is it a spawner? Spawner is a term by Monish Pabrai that I learned very recently and I have already implemented in my checklist. A spawner is a business that keeps creating adjacent business next to it. It could be adjacent, but also something unrelated that just works well with the kind of personnel and company we have. So, for example, if we have a company that makes pens and then they want to make pencils, so that would be another kind of business that they created. And then they might make notebooks and so on, right? So are they adding more businesses to it? Because that's something very powerful. Like, because we have a pencil business, but then we have a pencil business and a pen business, right? So this sounds super simple, but this is just a very dumb example. But it's something very important, right? I think it's good to check if they are. If they are not, that doesn't mean it's bad, but it's good to know if they are, right? And also a good way of checking that, because a lot of business will keep trying a lot of things. What we want to see if they are successful. So we want to see over 10 years or 20 years if that company kept pushing new business and those business stick and kept growing and worked, right? So we want to check that. 17th, this is where in 4 lines you should be able to tell the investing thesis, so just writing it there, and then in 4 lines tell the other side of the story, like tell the short side thesis, like why this business is going bad, right? In four lines also, and tell which one is very much more compelling, right? If the short side has some truth to it, then you should be worried, right? So that's what we're trying to do in the 17th. In the 18th is about the portfolio situation, because this is an investment doesn't happen in a vacuum. So we should check how it leaves our portfolio. I don't believe a lot in diversification, like not extra diversification. So between 3 and 10 plays, 3 and 10 investments are okay. At the moment we're like at 7, 8. So we're getting there. But if we're at 15 investments, adding another one just for the sake of diversification is not, I don't think it's wise, right? What will happen is we will know less about each of our companies, and that's not too good. And then also you want to check for correlation. Like if we have 15 different investments, but they are all miners, like coal miners, that's not diversification, because if something happened to the sector, you are all screwed. And also you don't have the best ones. For example, you just have a diluted amount. And you should ask you, how are they correlated, right? If they are all in the same country, that can have a small correlation also. So those things you should be checking. Then the last question is not really a question, is a rule. So if a investment I make starts doing bad, my rule is that I cannot sell it for 3 years. The only things that I can do to jump that is if the company really changes, like the investing thesis changes. If it's just a price movement, I don't care. Then if I made an analysis mistake, so I saw something and then it came out that I thought the margins were like 30% and in reality they were 10, that's an analysis mistake, and you should own to your mistakes and change. You shouldn't be tied to something that you made bad just to teach your lesson, because money is hard to earn. So if you make the mistake, you are okay to selling. And then it could also happen that a much better business comes in that meets this criteria even better. You need the capital. It's okay to sell at a loss and just take that capital to something more profitable. Also, you should ask you the question, if it fell 50% on the first day, will you be okay with it? Like, will you be happy? Because if it falls 50%, you can buy at 50% discount. So I think that's pretty good. Also, when I say, are you okay being locked with this investment? Let's say the market closed for 3 years, 5 years, 10 years. Did you buy a good company? Like, are you okay with just owning this asset, getting the profits from this business without the market part of it, right? So that's the end of the checklist. At the end, what we'll have is a checklist like this with all these questions answered, right? Also, you don't have to write it down. If you're okay just knowing the answer, that's okay. Also, do your own checklist. Like, I just show you what I do for every investment. But it's okay if you want to check, do your own questions and your own answer and methods. What I do is I take this document, I fill it with all the words, like with all the text, with all the answers, and then I go to this other document. Both links will be in the description, so you can have it. What I try to do is, for example, first questions, I read it here, I check my answer. This is blank. I thought of doing an example, but this takes many hours of doing, so I wouldn't want to do a video that long, too tiring, I don't have time. And also, I think it's good you do it on your own, right? But what would happen is I would have here the 3 answers, and usually what I have, I try to grade it from 1 to 3 or from 0 to 3. And that's why there are kind of 3 questions. Like if you know this question, you think you know it quite well, and this also quite well, and this also quite well, this would be a 3, right? So it keeps you like answering smaller questions. Because if not, like if the main questions we think, oh, this has a great moat, but then you would give it a 3, but then you go to the sub questions, like, is it costly for competitors? No, it's not costly at all. And can I find it in the other competitors? Yeah, everyone has this moat, right? So then at that point, instead of a 3, it's a 1, right? So that's why there are sub questions here. At the end, so you would just go here, put a 3, but then the moat, let's say, it's a good moat, it's costly, but other people have it, it would be a 2, right? Something like that. If it's very hard to destroy the business, like a 3, right? You should go here, see the answer, and try to answer it as objectively as possible. At the end, when you answer all of them from 0 to 3, you go to the sheet, to the next page, and you will see a score here. What it would give you is, once you have all the scores in, it should give you a score from 1 to 10, from 0 to 10, sorry. And you should see here that you have a very high score, right? Something very good. The checklist is not like pass or doesn't pass, right? It's up to you. Like, it's questions that you have to ask yourself. If they are properly done, you should end up with a company you're okay owning, right? So it keeps you in check. That's the entire thing. Well, everyone, since I haven't done any trades this week and no investments to talk about, this is all I wanted to share with you. If you're interested, please subscribe, leave me a like if you like this kind of tools and content. On the next video, I'm thinking between giving you my main research places and also my research criteria, like what I try to look in a company, and maybe do an example of that. Also, I'm thinking of doing a sector analysis, a full sector analysis, and showing you what I try to look in an entire sector, something on those lines. So just subscribe, stay tuned, and I will see you in a week or 2 weeks when I have time to do the video. Well, everyone, be safe, take care, and see you in the next one.